Welcome back all to Tech Tune Up with Paul Meeks. I'm Paul, no surprise. It's February 4, 2025. We're brought to you by my friends at Benzinga here on their YouTube channel, and also the firm where I manage some long-short technology assets, Harvest Portfolio Manager from my Bayou home, Charleston, South Carolina. So what we try to do, as always, is review some of the news, not just to do that, but to give you some actionable trades and also explore some of the tells, because sometimes what's in the news, whether it's about individual securities or not, has broader implications also that we can use to make money long and short. So let's start with some of the stocks and the stock tells in the news. Last week on this program, I previewed Microsoft and Meta's quarterly reports. Now I review them. I'll be brief because this news is already in the public domain. But Microsoft, I've been covering this company since 1986 when it went public. And this is a quarter, the first in a very long time, particularly since Satya Nadella came to the helm as CEO in 2014, in which I came away from the call feeling worse. There's always good things and bad things, pros and cons, and there were some positive things in the quarter, particularly their billings for their commercial business. But there were other stumbles, and I don't mind that, right? We're all human beings. We have our good days and bad days. And even the greatest companies have their good days and bad days. But what bothered me was the explanation for some of these miscues on the quarterly webcast by their CEO and CFO. Now, on a positive side, they did reconfirm their capital expenditure budget, which of course is mostly spent on AI gear, of about $80 billion for the year that's actually not too far away from closing. It's June 30th of 2025. If you annualize what they're talking about for the second half of this fiscal year, it looks like they'll spend 75 to 76 billion. So that's okay, but I didn't feel that much better about the AI trade because they talked in a little bit of a weird way about perhaps changing the mix of the spending on different stuff with that 70 to 80 billion. Not clear at all. And in the meantime, the stock has broken below its 200-day moving average support. And that, if you're a technical analyst, is a bad sign. I've held Microsoft for years. Of course, my cost basis is a sliver of where the stock trades today. However, if you give me money today, I'm not buying that stock. I'm staying away from it with fresh capital. On the other hand, the same evening, Meta reports their results, and I come away from that call feeling even better than I thought I would. And I was pretty bullish going in. It was going into that call, one of the few Mag 7 stocks that I would buy with new capital. But Zuckerberg and co. not only beat the numbers handily and gave good guidance for their core business, but I think that they were much clearer on their role building AI infrastructure and their role in the AI ecosystem over the years. What they'd like to do with their open Lambda model is they would like to be the world standard for open models in AI. And you think about it, they already touch through their Facebook properties about 4 billion of the 8 billion people that live on this planet. And so who else could be better suited for that? Obviously, they're in the incumbent position. So I really like what Meta is doing. They're going to do some things this year, also including better monetizing Instagram Reels that should really show an acceleration in their fundamentals in 2025 into 2026. I expect a good year. And if you give me money today, yeah, I'm buying Meta even after this big stock run. Tonight, we have, so stay tuned, two other companies reporting that I think are pretty interesting. You have Alphabet. I think Alphabet's quarter is going to be solid. but I'm also interested in what they say. Do they reconfirm their AI capital expenditures? And also AMD. AMD has been in a death spiral. Take a look at that chart. I actually think that so little is expected of AMD that if they have even a whiff of good news, that stock could bounce like a coiled spring. I actually think if they can stabilize this business and give us in their commentary any hope for the future, it is probably today one of the best long-term values, though of course it is a contrarian play in the entire tech sector. So stay tuned. We'll know about this at about 4 or 5 p.m. Eastern time today. Amazon's reporting next Thursday. I expect more solid. But I'm also, of course, with all these AI trades, what are they going to say about their expenditures? Are they going to stick with the absolute dollar amount that they promised for this year? Will they give us any indications that it's going to grow in 26 over 25? We will see. But for the longest time now, my favorite stocks in the Mag 7 have been Amazon and Meta. Probably still are. Palantir. Now, this is one, shame on me that I didn't participate. I've always been spooked out by their CEO, who is Alex Karp, who is uber promotional. But they reported yesterday another very nice quarter, and I am now sold on their fundamentals. I just want to buy the stock at a lower price. And as I've said in previous telecasts, I'm most interested in the fact that not only is their government-oriented business, it should do very well in Trump 2.0, but also they're finally successfully diversifying into commercial customers. And so I like it, but you know what? I missed it. And I will tell you this, even a company like Palantir, it's very, very expensive. They only earned 14 cents a share. You annualize that. This is a stock that has an infinite PE. It's very, very expensive. It's egregiously priced, even with improving fundamentals. So what that tells me is any whiff of bad news, and all companies will have it, that stock will get hit. And you know what? If I still feel convinced on those fundamentals, which I am today, I'm going to buy it on a dip. That's my plan. Next, the same thing goes with Spotify. Pretty solid quarter just released. Finally, after years and years and years of spending to build their profile, we now have a company that has turned profitable and probably should continue to be. So, continued revenue upside. They cut a lot of costs over the last couple of years to reach cash flow positive and earnings positive. Same thing goes, feeling good about Spotify, want to buy it on a dip. And you know what? The dip will be a-coming. It always happens. I think this news about TikTok and Trump is very interesting. So, as you know, Trump has signed an executive order, which he does not need to be passed through Congress, in which we are going to create a United States sovereign wealth fund. You may know that the world's largest sovereign wealth fund is Norway's, that has over $1 trillion in assets because they are just repatriating the capital they get from the booming offshore oil business. But it seems that Trump really wants to own TikTok, i.e. the federal government, or to co-own it. So this step to create a sovereign wealth fund that fund, and then at least co-invest in TikTok, it could happen. I think it's pretty interesting. In the meantime, if there are any continued stumbles and that doesn't happen for one reason or another, who's the greatest beneficiary? It's our buddies over at Meta, because Instagram Reels has taken some share with all the controversy at TikTok from that Chinese-based company. Apple announced last week, this is like the Teflon stock. I remember when I was growing up in the 80s, they used to call Reagan the Teflon president because no criticisms would stick. Apple reported, I thought it was a pretty disappointing quarter. iPhone revenue actually down, and iPhone is 60% of total revenue. Revenue from Greater China, which obviously includes mainland China, just got crucified. I think it was down 11% year to year. Overall, the company only grows 4% on the top line, and the bottom line, their earnings grew 7%. You guys, 4% and 7% is not the growth of a tech company. This is growth that is probably even below the average company in the S&P 500. Now, the beauty and the reason that the fanboys keep on being fanboys with this stock, even though I don't think it's appropriate, is their services business, which is a high margin business, as a 75% gross margin business. And you can expect gross margins in products of about only 40-ish%. That's great. And it's growing at a reasonable double-digit clip, and it's bringing higher overall gross margins with it as it becomes a bigger part of the mix. But I will tell you this, even that business isn't growing as fast as you can get with other technology plays. And we could have a situation where if the feds get their way, they will end this cozy relationship between Alphabet and Apple, whereas Alphabet pays over $20 billion a year to Apple to get a head start on using what they have as their browser on the phones. So if the government says that ain't cool, that's anti-competitive, you have Apple's $100 billion a year service revenue business, you'd probably lop overnight 20 to 30 billion or 20 to 30% off of that. And that's, again, high margin revenues that you could lose. Stay tuned. Same thing goes with Apple. They still generate so much cash because they pay so little in capital expenditures and so little relative to their size in research and development expense that they continue to generate a lot of cash. I guess it's attractive for that reason. But I tell you, I've been covering tech for a long time. My tech companies have to grow their sales. And these guys haven't really grown their sales ever since they had a nice boost during COVID where everybody was buying hardware. We'll see. Tesla, they also reported, I thought it sucked. Their EV business sucks. But of course, Musk diverts the conversation, the narrative, to an autonomous taxi and also robots. Remember, and I've said this before, he first started talking about autonomous taxis in 2015. And at that time promised in 2016 that there are going to be 1 million of these on the street. Well, we got 0. So I'll believe it when I see it. And I do think at some point you're going to have a breakup between Musk and Trump. And a lot of the reason that Tesla is up almost, again, another Teflon stock, regardless of their poor fundamentals, is because of the relationship. Some people say that these dudes are co-presidents, Trump and Musk. You are two alpha males, and they are going to step all over each other with their comments. And at some point, there is going to be a breakup. If you have a breakup of this bromance, that stock, Tesla it is going down. So Tesla is one that I'd actually consider shorting at some point when it's overbought. Apple, I never would, even though I don't believe in the fundamentals here, because you just can't short a stock like Apple that generates so much free cash flow. OpenAI, I think, is very interesting here. They have this new deep research. They're trying to compete with DeepSeek on the next level of AI. And then they also have signed another agreement. They seem to be getting very cozy in Japan with SoftBank. And they originally had signed this partnership supported by Trump. You had SoftBank, you had Oracle, and you had OpenAI. They're going to spend $100 billion in the first year with the Stargate project, building AI infrastructure, and up to $500 billion combined over 4 years. So even beyond that announcement, which was a couple of weeks ago, it looks like OpenAI and SoftBank are doing more and more things together. Maybe that was part of the grand plan from the get-go. Anyway, I find it very interesting. ASM Lithography, which is the Dutch semiconductor capital equipment company. I made a contrarian call because this stock was pretty hated at about $670 a share. It's gone up. They actually had a pretty nice quarter, even though the expectations were low. They are definitely getting bit in the ass by being wrapped up in this US export restrictions of their gear sold to China. But it still looks like the future is bright. I'm happy to own ASML, happy to get in. It was a kind of a value, non-momentum, contrarian pick for me. So with that being said, let's get on to some of my tech picks. Now, this list always shuffles a little bit. And particularly, remember I told you that tonight we have Google and AMD, always stocks on my watch list. And next week we have Amazon. Not only will they be talking about their own fundamentals, they will confirm or deny their AI capital expenditures. If they confirm them, you could expect to see a bounce in companies like Nvidia. If they say, oh yes, this very cool thing out of China called DeepSeek has me rethinking if I need to spend tens of billions of dollars like these companies have been doing on AI infrastructure. That could, even though Nvidia has come way back, that could bite them in the ass again. So I expect more action on this list over the next week. So in red, we have the stocks that I have been throwing the towel in on. The one you see right here is Micron. In yellow, you have stocks that have remained in my bullpen. Maybe at one time I wanted to buy them with fresh capital, but they've been demoted, like from the majors to AAA. And those are companies you see here, like Microsoft, right? I told you I was just really bummed out about their quarter and their quarterly presentation. Nvidia, even mighty Nvidia, I still want to hear about the CapEx from these hyperscalers this week. Alphabet, PayPal disappointed me last night with their quarter. ASM Lithography, it was a contrarian pick. It's done its thing, but I don't buy any more here. I'm into it at 670. AppLovin and CrowdStrike, I own, but I'm not going to buy them here, waiting for more news. And I told you that I do like the fundamentals very much of Palantir and Spotify, but I'm waiting for a dip because you know what? Shame on me. I wasn't in early enough to capture the move in the stock price. And now I think they've gone way too far, way too fast, particularly Palantir. T-Mobile has been on my list from time to time. They reported last week, and I do like T-Mobile as kind of a more defensive, what I call chicken shit tech name, right? You have sector exposure, but not the downside risk that you might have with all the AI infrastructure trades. Everybody knows that I'm a tech analyst, but I do find opportunities because I have some great institutional connects with analysts and portfolio managers on the street covering every sector. I just cover tech. I am intrigued by the blow up that we've seen in Deckers. Deckers, and I'm not going to get into the fundamentals too much, right? They make sneakers. They have the Hoka brand. My consumer analyst has been absolutely right on this company over time, and he thinks it's a buying opportunity because this stock, when they reported, and I think it was really a threat of Chinese tariffs, and also the expectations had gotten way ahead of the stock price. This could be a good opportunity. I'm doing the homework on it now. On my fresh money buy list in the green, Meta, Amazon, Broadcom, Taiwan Semi, Netflix, which is the only tech stock I've been buying the last couple of weeks, Guidewire, Citigroup, not a tech stock, a bank, but it's done great. Marvell, Boeing, I talked about the turnaround in Boeing last week, T-Mobile, and Constellation Energy Group. I'm always asked on this program by the same person probably about my view of these new era energy companies, right? The nuclear companies like Constellation Energy Group that are going to fund AI data centers. I have owned them. I haven't been in them for quite a while because they probably rose too much. But Constellation Energy Group has come back recently. I'm pretty pumped about that. This is the one that I would add to. And one of the reasons why is I'm very bullish on their acquisition of Calpine. If the regulators let the deal go through, and I think now that Trump is president, it will go through, a really powerful combination in the utility space. So, yep, back in my good graces. CEG, Constellation Energy Group. Let's now just finish up with some tech trends. As always, watch interest rates, and the calculus has become more confusing because although we have the same Fed chair, Jay Powell, that we've had for several years, we have a new president of these United States. Of course, the Fed is controlling monetary policy, and their big lever that they pull is lowering interest rates when the economy is weak and raising interest rates when we're trying to fight inflation. Now, before Trump came on the scene, or at least until he was elected, the Fed had been raising rates for years to slow down inflation. Now, they've gotten inflation now to not to their target, not low enough, but to a manageable amount. And so 6 months ago, they were targeting that they're going to continue to lower rates, which they started doing last September. But now that Trump is on the scene, not just they, but others are worried that some of his policies, particularly the tariff, could be inflationary. And if they are perceived as inflationary, and if they become inflationary, then you have interest rates rising because inflation is rising again. And that could be really bad for the tech sector. So I watch this very carefully. So the next time the Federal Reserve Board meets, our central bank, the Fed, is March 19th. And if you take a look at the CME FedWatch tool, which I do every day, it is showing that there's about 70% chance that, just like the last meeting that was a couple of days ago, that the Fed will keep interest rates unchanged in March. So the appearance or the prediction that we're going to have interest rates fall, which was originally a plan for 25, doesn't look like it's going to happen. So we'll see. And of course, tariffs are a big part of this. I think that that tariffs are going to be paid stateside by who is picking up the goods at the Port of Los Angeles. And if a company is lucky, it is going to be able to pass along that tariff, increase the price of the product, and you're still going to buy it. If they can't pass on their increase in cost of goods sold, then they're going to have to eat operating margin. And that's not a good thing. And so we'll see what happens. But I think, and I'm an economist and a college professor, yes, there's some positives and negatives to everything. But I don't think, at least my personal opinion, that tariffs is a good tool to use, particularly now when we're worried about inflation and we thought we were just on the other side. I think net, that tariffs are inflationary. So we'll see what happens. But obviously, every CEO, every CIO, every CFO in the tech sector is looking at this carefully. And any uncertainty is going to lead them to maybe pull back on capital spending, not hire as many people as they originally planned. It's going to cause some uncertainty and confusion. Of course, everybody hates that. I thought this announcement from OpenAI that they've launched something called Deep Research takes their model to the next level. And of course, what precipitated this announcement is the announcement from the Chinese AI lab DeepSeek that they were perhaps getting ahead of OpenAI with a much lesser cost and much less time to develop their model. We'll see what happens, but I do think Deep Research takes us closer to what we call AGI, where you can actually have AI do some tasks independent of you, not just help my students cheat on their homework. I think it could be really interesting. And the last thing I'll say is I always watch the confluence of the finance sector and the technology sector, fintech. And I thought it was a really interesting announcement that went under the radar last week that the former Twitter, which is now X under Elon Musk, signed a deal with Visa. Of course, Visa has a lot of clout to do something together, to create what may be, through X, a super app in which you can do all your transactions, just like the super apps that already exist in China. So watch out for opportunities between fintech companies. Very, very interesting. Remember, on my buy list now for a couple of weeks is Guidewire, GWRE, and that's a tech company that serves the insurance industry. Keep an eye on those partnerships. We'll see what happens. Before I wrap up here, do we have any questions? What do you think the ultimate fallout will be from DeepSeek AI? I think the creation inexpensively in a very short period of time is significant. However, I also think that DeepSeek made some claims that probably are bullshit, right? I doubt that it took them only $6 million. I doubt that it took them only 2 months, but they were innovative. Even all the top competitors in the United States have said innovative, including Jensen Huang over at Nvidia. But I think what happens with any technology in the long run, if and when we can reduce the cost of AI infrastructure spend, and we can deliver these models more quickly, more efficiently, more cheaply, it is just going to boost the demand for AI tools and AI apps. And at the end of the day, this will be a boon for Nvidia and AMD when they finally get their act together. You've asked me here about Intel. I think those guys are screwed. I don't know if that company can be turned around. I would take that stock off your list. Remember, AMD, depending on what they say tonight with their quarterly webcast, is kind of in my bullpen. I'm investigating it, not ready to pounce. I'll let you know next week. Nvidia, even though the stock has come way down, I'm not buying anymore. I'm holding off. I want to see the stock get flushed out. But I think over time, if DeepSeek is real, and part of it is real, their innovation, part of it is fake, some of their claims, I think overall it's going to be good. It's going to be good for all these guys after maybe some short-term anxiety, and that's what we're experiencing right now in the market. But great question. I get asked this question all the time. Are you long Mercado Libre? No, as I shared, I sold my shares a while back. If I am going to make an e-commerce play, I much prefer a Mercado Libre, even including another payment processor company in the States like PayPal. But I was getting a little freaked out. And with Mercado Libre, you have some geopolitical risk. So I will be back in the name, right? You probably remember I touted it here, but I took it off my fresh money buy list quite a while ago. Would Netflix have a stock split soon? Very well could, with the stock price up here at this handle. I'm very bullish on Netflix. I've said so. It's the only stock that I've been buying on dips ever since they report. I thought their report was just outstanding in every aspect. Now they're getting into live sports, and now they're raising prices. So all good things there. And all the other video streaming wannabes, like these legacy media companies that are trying to become Netflix, I always say to people, short them. And if you want to play this theme, just double down again and again and again on Netflix. I have no reason to think that a stock split is imminent, but with the stock up here, wouldn't surprise me in the least. But of course, that a stock split is cosmetic, right? If you split a stock 4-1, the next day the stock price will be cut by a divisor of 4, but you will also have 4 times as many shares. So for existing shareholders, it is meaningless, it's superficial, but it usually does get people jazzed anyway. And so we'll see. Wouldn't it all be surprised if Netflix does that at some point? But I haven't heard anything recently, and I'm pretty close to contacts there. All right, guys, I appreciate your help. And I will tell you, if you have a question for me, I know it sounds odd, reach out to me. Like, for example, one of you, which is a really smart dude, I won't embarrass him with his name, from New Orleans, called me up and we talked tech for half an hour last weekend. And I assume that he found me here. So anyway, if you have a question, reach out to me. I'm super easy to find, particularly through LinkedIn, where I have a lot of my content, or through Harvest Portfolio Management, or even through my buddies at Benzinga. So you guys, stay tuned. We're in the middle of the tech reporting season. We got some biggies this week, and I'll be reporting about that and everything else next week. Have a good one.